Ladies and gentlemen, good day and welcome to the Q1 FY23 results conference call of Shri, Keshav Cement and Infra Limited, hosted by Kiran Advisors Private Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be no opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Supriya Madhye from Kiran Advisors Private Limited. Thank you, and over to you, ma'am.
Thank you. Good afternoon, ladies and gentlemen. On behalf of Kiran Advisors Private Limited, I thank you everyone for joining the second conference call of Shri Keshav Cement and Infrastructure. Today we have with us Mr. Venkatesh Katwa, Chairman of Shri Keshav Cement and Infrastructure. Now I hand over the floor to Mr. Venkatesh Katwa. Over to you, sir.
Yeah, thank you, Supriya. Hare Krishna and a good afternoon to everyone. I trust everyone must be in a great health today. And as we know, today is an auspicious day of Raksha Bandhan. I extend my warm wishes to you all on the call on this occasion. So to begin with, I thank you for being attending this call, and I welcome you to the second conference call of Shri Keshav Cement and Infra Limited for first quarter the financial 2022-23 results discussion. Just to brief again about our company, Shri Keshav Cement and Infra Limited is a public limited company which was incorporated in 1993. The inception of the company began with the acquisition of a small SIC unit in 1994 of just 20 tons per day. So the plan was gradually increased to the current capacity of 1100 tons per day, which is almost 0.35 million tons per annum capacity. We have two manufacturing units, both in Bagalkot districts of Karnataka. And currently, as of now, we operate into two business segments. One is manufacturing of cement, which has been our inheritance since the beginning. And second is generation and sale of renewable power, mainly into solar as of now. Shri Keshav Cement crossed 100 crore revenue milestone financial year 22, and which was pretty much in line of our projections and our growth trajectory. We continue to post better sales and profits compared to the previous period. Even for this quarter one, the sales has increased by 22% and achieved nearly 7% increase in actual cash profits. This is again comparing to the corresponding previous period. As we all know about the geopolitical situation of the Ukraine war, certainly there was a dent on the fuel cost. There was certain energy crisis which was imposed on the economy, and no industry who were dependent on the fuel were isolated. Based on that, there was some impact on the company due to cost of fuel, due to which the EBITDA margin, which we consistently posted between 33 to 35%, came down to around 27%. And this we hope will not continue, as we see that the fuel cost is already showing the signs of relaxation. Now, specifically regarding cement business, our this quarter has shown average selling price increased by nearly 2% and quantity selling by around 7% more than the previous period. The price itself has not increased significantly because of still some kind of overcapacity into the industry. EBITDA margin was subdued on account of fuel prices, like explained above. But there is a robust initiative from the government to develop infrastructure. We foresee that cement will continue to be in demand in future. The capacity utilization, which has seen improvement compared to previous period, will continue to improve going forward. Regarding the renewable solar power business, as discussed last time, a new 12 megawatt peak solar plant was commissioned in December 2021. This plant has already stabilized and is working as per the plan. So the average realization of sale and average realization price and sale of solar power has increased by 8%, but the sale has increased by 245% compared to previous period. Obviously, this is because of the new 12 megawatt peak solar plant, and this will continue to show in the future quarters too. The power generated from the 12 megawatt plant, or generally the renewable power, will be a major contributor to the EBITDA in all the ensuing quarters as we see today. So looking ahead, the financial performance is expected to be positive, as the management is of the opinion that fuel cost will rationalize in ensuing quarters, as we are already seeing it right now, thereby contributing to better margins. Power, as it is, will continue to be a major EBITDA contributor. Company is in the final stage of conducting a technical feasibility to optimize the cement plant and increase the capacity by nearly 3 times to 1 million tons per day. So what we are trying to do is, the existing cement plant, we will be implementing the latest technology in grinding and optimizing the kiln, thereby reducing the cost of utilization of fuel compared to now. We will be saving about 20 to 22% of fuel per ton of cement, thereby increasing the EBITDA margin. The feasibility is almost at the verge of completion. We should have it very time soon. So again, going to the financials, sales has increased by 21% to 32.57 crores this quarter. EBITDA is reported at 9.37 crores. Profit before tax is 2.96 crores, up by nearly 21% compared to the previous year. The PAT has gone to 26 crores compared to 5.19 crores in the previous period. Now, due to profitability achieved last year, there was a deferred tax asset which contributed to profit after tax, thereby which all our ratios, like the debt equity current ratio, have significantly improved compared to the previous quarter in the last year. So with this, I thank you, and I would open the session for any questions anyone might have. Thank you.
Thank you. Ladies and gentlemen, we will now begin with the question and answer session. Anyone wishing to ask a question may please press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, if you wish to ask a question, you may please press star and 1. The first question is on the line of Sachin from Savir Power and Automation Private Limited. Please go ahead.
Yeah, good evening, sir. This is Sachin 50 here. So the first question is related to revenue. Last quarter our revenue was 36 CR, and this quarter our revenue is 32 CR. So I just wanted to know. So sales are here. The sales are declined quietly, around 10 to 15%. So what is the reason, sir?
So cement is typically being a cyclical industry. You would see that Q4 results are always on the higher side compared to Q1. Typically, Q4 always has the largest percentage of sales, pretty much because the March ending, there is a pressure for the government to complete the projects and a lot of deadlines, which is why we see a huge sales during that period. So I thought comparing it with the corresponding quarter of the previous period would do justice. And if you look at that, we have increased the sales by about 22%. And if we continue to keep this ratio of increment, it will start in the ensuing quarters. It will show a better sales compared to the previous quarters.
Okay, thank you, sir. So my next question is that raw material costs have significantly increased. Last quarter it was 15 CR, now it is quite 20 CR. So how do you see next quarter, the next upcoming quarters? Does this raw material prices will be stabilized going forward due to fuel prices, or what do you see next upcoming quarters?
Yes, like we discussed, the fuel cost typically increased by almost 2.5 times. Even though companies shifted from South African coal to petcoke. Petcoke is compared to lesser cost compared to coal. In the first quarter, we completely utilized petcoke. If we had still coal is almost 1.5 to 2 times expensive compared to petcoke. But what happened on absolute terms, the cost of petcoke also rose to a level of what it used to be of coal earlier, which is why our EBITDA margin dipped. But in ensuing quarters with Ukraine war, slowing down on the impact, we have already seen the price being rationalized since this month onwards. So we hope that this month in ensuing quarters, the fuel price will start going down as expected, and we will come back to realizing the similar EBITDA what we have done in the past.
Okay. And so the depreciation is, I think we have capitalized with solar project. That's why the depreciation will be high this year. So next quarter, I think it will be told this year. Is it right, sir?
No, come again with the question.
Depreciation and amortization expenses are saying 3.18 CR. So yes. This is because of we have capitalized on solar power plants of 45 CR. Right?
Correct. Correct.
So next quarter also it will be the same.
Almost similar. This is going to be almost similar before next it will start hitting down. Yes, we have capitalized the solar 2 or the 12 megawatt power plant which we have set up. The depreciation has started from the first quarter itself. Yes, eventually it will start slowing down. You're right.
So last month you announced some capex of 1 million tons. So what is that exactly? How much capex we are doing for this cement factory?
So right now we are at 0.35 million tons per annum, or it's about 1100 tons per day capacity plant. So what we are trying to achieve is by optimizing the kiln. Basically, our whole attention is to optimize the kiln operations. The optimization of kiln operation means we will be constructing new preheater tower and certain equipment by which the existing kiln itself will start giving about 10 to 20% more clinker, but of the highest quality with the best chemical structure what we look at. With that, we will be adding the additives like slag and fly ash. Currently, we are not able to add beyond 30%, but with the new technology, we should be able to add 50 to 60%, by which what is going to happen is the total grinding capacity will increase from current 1100 tons to almost 2,800 to 2,900 tons. So basic information we have already received that the project cost is about 110 crores, but we are yet to receive the finalization with all the details. Hopefully, we are expected to receive by next month, and we should come back with the actual project cost and what it will look like. Now, with this 100 crore investment, we are expecting an additional EBITDA only from this expanded capacity to 50 to 60 crores. So, and this is a good juncture for us to look at this kind of optimization, because we are not going to buy the land. We already have the clearance from the government, plus certain equipment. When we had done the expansion in 2018, the equipment were put considering this future expansion in mind. So 100 crores is almost, you can say about 2,000 rupees per capital cost is much lesser compared to about 8,000 rupees per metric ton what is been established for cement plants. So yes, we are looking at it right now, and hopefully in a couple of months we will be coming back with actual figures and facts on how this project is going to be implemented.
And how much is the leading period is required to complete this capex? If you finalize this capex, we have to go ahead for 100 CR. So how much time is required to complete this?
Okay. For some reason, I'm not able to listen clearly. Are you asking how much more debt are we going to take?
Yeah. So my question is to you. So once we finalize that, we have to go ahead for the capex. In that case, how much leading time is required to complete that capex? You know, that 100 CR capex. How much time is required to complete?
Sure. So typically, we would say not more than the earliest could be 2 quarters, the latest could be 3 quarters. So within 9 months, from the first digging to first bag coming out of the packing machine, it could take maximum 9 months.
9 months, okay. And the EBITDA of this means asset to turn and EBITDA is around 50 to 60 CR Just now you
Yes,
said, right?
that is the additional EBITDA is what we are targeting based on the savings what we're getting. So what is going to happen is your fuel cost, you save about 20-25% in quantity, and then you save about 20% in power. So whatever you save the power, you're going to sell it outside. So both these savings together, your EBITDA margin per ton is increasing compared to current. So with that increase, then you can realistically expect higher EBITDA for cement division. That is the whole idea behind arithmetic behind the optimization and expansion of the cement plant.
Okay. So approximate PAT, how much it will come post expansion? EBITDA it will be 50 to 60 CR, then PAT something 40, 45?
PAT, is it? Did you say PAT?
Yeah.
No, I didn't specifically calculate the PAT, but yes, it could be around in that region only, 40 to 50.
Okay, okay. So I'll come to the question. Thank you for answering.
Sure. Thank you, Sachin.
Thank you. The next question is on the line of Apurva Raj from APV Raj. Please go ahead.
Hello?
Yeah, good afternoon, sir.
Yeah, good afternoon. My question was, cement industry, they are giants, all big entities, big name, big plants. So how we able to manage competition, or what is something we have that we are competing with them and also expanding and growing?
Definitely. So Raj, there is one couple of advantages what I can list out. One is the locational advantage. So we are located in the North Karnataka region where there are no major cement plants. Other than a couple of them, all the cement plants in Karnataka, most of the major plants are in the Gulbarga region. So for them to come to our area, cement being a bulk product has a huge logistic disadvantage. So the location advantage is one thing which we are thriving upon. Secondly, what we are doing is the management is continuously focusing on investing in technology. So with this new capex, what we are contemplating, it will have one of the best technologies available right now, almost equivalent to what all the major plants are doing, by which we are expecting a much higher quality of clinker. Higher quality of clinker obviously means better. We can go for better additives, increase in the capacity. The cost of cement production will go down drastically. And apart from that, we already have an established brand name. With that, we have a good indication that we will continue to grow. It should not be as a challenge as, we would have been a challenge if we had a lot of major plants around us. So that location advantage, no one is going to take away from us.
Yeah, so basically, the one of the biggest costs for the cement companies is transportation, which is also an advantage for you.
Correct.
So, sir, how much is the percentage of exactly your transportation cost? Because fuel cost has gone up drastically and it has impacted transportation costs, especially products which has a higher percentage of transportation costs. So how it is impacted?
So typically what we are doing is we are selling the mix of X plant and we don't typically have C&F godowns like what major plants have. Most of our cement directly goes from a cement plant to the dealer or the authorized dealer. So logistic cost to the most extent is borne by the dealer itself, unless in some cases where we have to do it, but of course that cost is recovered from him. So we keep our logistic costs at the minimum by making almost all the sales that you see is X works basis as of now. X works and X taxes basis.
Okay. And sir, do you have any plan to go on a more and more value-added products like cement and ready-mix, and then again more better and updated technologically improved value-added products, something like so in your value chain? I mean, where you want to go, that this could be the nearest term where value chain till now in the value chain till now we are here, and next target is to achieve that level in terms of product.
So typically, as of now, the management is focused on the capex and reduction of the cost. So once that is done, there are certain few other things which is within the side of the management, like the RMC, like cement boards and panels, like 2D and 3D construction. But this is something which we're going to look at after the capex is completed and we have stabilized on that. And those kind of industries, what I'm talking about, are purely service oriented, which the major cost comes from the cement itself. So we will be working in that direction eventually. But yes, these are some long-term plans which company is already contemplating to look at.
And ready mix and all you already have.
Again, what?
Ready mix and all you already have it?
No, we do not have ready mix as of now. But that is one area which we will look into the moment we are done with the capex, or we are almost completing with the capex plans.
Okay. So already
eventually, what we want to do is we want to utilize our entire cement for creating the product itself, as opposed to selling the cement itself. The product will have a better margins, and there will be generally lower in taxes. That is going to definitely help us contribute better compared to selling cement directly.
Okay. Thank you very much, sir. That's all from my side.
Sure. Thank you, Mr. Raj.
Thank you. A reminder to the participants, anyone wishing to ask a question may please press star and 1. The next question is from the line of Sandeep Mane, an individual investor. Please go ahead.
Hello. Good evening.
Go ahead. Please go ahead, Sandeep.
Yes, sir. FY22 witnessed a rise in utilization level to 63. Is it?
Come again. Utilization is what?
FY22 witnessed a rise in utilization level to 63%.
Correct.
Yeah. So my question is, sir, can it sustain this level, or we can see more increment from here?
Yes, definitely, Sandeep. The first quarter we already achieved 68%, and if you look at the industry average being about 80%, we are pretty sure we should reach 80% in next 3 to 4 quarters.
Okay.
But that being said, basically what happened was till 2018 our capacity was 1/3 of what it was right now, and we were reaching almost 100% capacity then. So in last 3 to 4 years, our capacity utilization increased from almost 40% to 63%. So this quarter we clocked about 68%, and we will continue to grow based on the performance, based on the conditions of industry.
Okay. My next question is, sir, long-term borrowing are increasing and there are no provision made. Is there any plan to reduce or restructure debt in upcoming quarter or years?
Yes, most significant portion of the long-term borrowing comes from the solar capacity. That is because solar is a very high captive, very high captive cost industry. Now, what is going to happen is, since solar also is contributing the highest EBITDA, it is taking care by itself. And this high debt is replacing the cost of electricity for us. So in a way, even though it appears to be a very high capital cost, but our EBITDA is there to support it by nearly about 2 to 3 times.
Okay. So my last one more question. Since the top clients' contribution has increased to around 70%, so how certain are we to get the order in the long term?
So top line to 70%. Can you clarify the question, please?
Sir, since the top client contribution has increased to around 70%, then how certain are we to get the order in the long term?
Okay, I'm still a little confused. Okay, let me figure out the question. So 70, where did you see the 70% actually coming from?
Sir, contribution of clients, sir, top clients.
All right, client. I'm sorry, I didn't hear that. Okay.
Yeah.
Offline, I heard. So you're asking me if the contribution of the top customers is 70%.
Yes.
So we are planning to get it done, and it is kind of coming down anyway. As we spread around and we get into more of government-related contracts, we will start beginning to be less dependent on the top level customers. And of course, when we go deeper into the villages, we also get a better realization and better reach. So yes, the management is continuously working towards achieving those levels.
Okay.
Yeah, I'm sorry for not working correctly.
No problem. So lastly, are we planning to do capex with the rising cement demands?
Capex, in cement we are doing the capex, right?
Yeah.
Yes, typically cement we are looking to do the capex, and we are almost closing on the feasibility of the capex. So, like discussed earlier, the capex will be about 100 to 120 crores, and EBITDA contribution is going to be about 50 crores for that extended, plus existing EBITDA what we are achieving now. So we are targeting almost EBITDA of nearly 90 to 100 crores once the capex is complete, and we operate about 80% capacity.
Okay. Thank you, sir.
Sure, Sandeep.
Yeah, thank you.
Thank you. The next question is from the line of Avinash Gorakshakar from Profit Mark Securities. Please go ahead.
Yeah, sir, I've got 3 questions. First is, what is the outlook on cement prices now going forward? And secondly, you mentioned about your capex, of 120 odd crores. Could you give us some idea about how much of it is going to be funded from internal accruals, how much of it is going to come from debt? And the third question is on a very broader level, now since infrastructure growth has picked up, we have seen that, corporate capex activity has started, increasing. Could you share with us what is your medium-term view on the cement sector, specifically as far as, your side, your location side is concerned, considering that, you are one of the few players who have got, capacities here. So in terms of demand growth outlook, what kind of outlook do you perceive?
Sure, Avinash. Good afternoon to you. So let's look at the cement outlook itself for this quarter and the remainder of the year. So this quarter 2 typically being a monsoon season, it's very cyclical, and as expected, we will see our production and results in line with typically all the major plants. So there won't be much significant change in the quarter 2. But again, as we know that India is still one of the lowest per capita consumer of the cement, and that the central government is so boosted up. There is a robust growth expected in building of the infrastructure, which will obviously mean that the outlook is going to be on the brighter side. And this we have consistently seen in the last couple of years too. So as we keep moving towards direction of better infrastructure, I feel that cement is going to be a product with the very bright future. And regarding the capex and the means of finance, typically as of now we haven't decided on the exact mean of finance. But in the past, what we have done is the promoters have invested equity in the form of unsecured loans, and then the remainder we have taken debt from the bank. So either we will stick to same, or we may do some placements to get some equity, or a mix of both. So that is what will happen once we finalize on the feasibility of the project itself. And the general view on cement demand, not now and in future, is, like I said, among SAARC countries, India is still one of the lowest consumers of cement. I don't think so. Other than Pakistan, we are still rallying ahead when even countries like Sri Lanka and Bangladesh. Even Nepal is ahead of us in per capita consumption. So we definitely have a long way to go. As per Cement Research Institute, from 2023 to 2030, cement CAGR expected is around 11 to 14%. And if that is consistently achieved, we would need not less than about 800 to 900 million tons cement capacity in India by 2029 and 30. Our current capacity, installed capacity is around 500 million tons, and the utilization is about 375 million tons. This is as per the statistics provided by the CMA or online data, what you look at. So yes, I see there's a robust growth. Still, we are yet to come to a level where infrastructure has to be equivalent to a lot of other Asian countries. And I feel cement is the only product which is not replaceable right now, and it will continue to grow. And of course, in my region where we are operating at, there are no major capacities, so that locational benefit will continue to accrue on us. One of the reasons is there are no huge limestone deposits available there in our region, which will attract bigger players or large capacity players, which of course means there is for 1 or 2 million tons it is okay, but if you have to think about 20 or 30 million tons, which large corporates want to look at, that advantage, locational advantage will continue to accrue on our business. So I hope I answered the question, Avinash. Did I miss something?
Yeah, I think we're very well articulated, sir. Thank you.
Thank you. The next question is from the line of Nilesh Karani from Magnum Equity Broking Limited. Please go ahead.
Yeah. Good afternoon, sir.
Yeah, good afternoon, Nilesh.
Yeah. I'm audible, no? Yeah.
Yes.
Yeah. So just to understand, see, our solar power, basically you said 12 megawatt, if I understood correctly.
12 megawatt peak is what we mentioned. It is like AC capacity is 10 megawatt.
Okay.
AC capacity is 12 megawatt. We usually say 12 megawatt peak because that's the investment goes for.
Correct. So basically the whole 10 megawatt, basically do you sell out or you utilize it for captive consumption?
So to answer that question, what I'll do is I'll go a couple of steps back. Now the first plant that we have is 20 megawatt AC and 25 megawatt DC. Okay. And the next power plant which we commissioned in December was 10 megawatt AC and 12 megawatt peak DC. So I'll use this term interrelating, or I'll call it first one as first solar plant and second one as second solar plant. Mm-hmm. So what happened was when we commissioned first solar one plant of 20 megawatt AC capacity, government had given us a host of incentives in the form of when the power is distributed, there are losses, there are charges, all of this, and there are cross subsidy charges. All those charges are waived off for 10 years. Since we commissioned itself on March 31st, 2018, which was the last day for us to accrue the benefit, so we will continue to accrue the benefit till 28-29. There is 5.5 years to go with. But if this is even if you sell the power or even consume it, by which what management thought was it was not a good idea to consume power from this plant because this plant has host of incentives. It is better to sell power from this plant to continue to get the benefits, which is why we commissioned another solar plant of 12 megawatt peak. 12 megawatt peak plant does not have any incentives like the first plant, but incentives are there if you do captive consumption. If you want to sell it, then all the charges, the losses will be impacted on that plant. So what we did was, we are consuming power from the second power plant and we are selling the power from the first power plant. For the first power plant, since there are no other charges, we are realizing the fullest benefit. In fact, my last year average realization of the price was 6 rupee 10 paisa per unit. Last year, in this quarter, is about 6 rupees 70 paisa almost. So, yes, as of now, the capacity expansion in solar has been a great contributor towards EBITDA.
And so basically, how do you see this part of your vertical, panning out? Like once you are done with your this thing, first, and there's already the PPA and all have been done with that thing, or you supply to the grid?
So did you ask me about the PPA, right?
Yeah.
So what we have done is we have not signed a PPA with the government at all. We are selling to private parties. Because when we set up the power plant first, it was mentioned only for as a captive use. Eventually, we took a permission from the government to sell the power to third party. and all our customers are, in fact, the demand for power is so high that we are actually rationing to the customers and taking the best price available for that particular month.
Okay, okay, sir. So basically, it is a win-win venture for the company as well as procure for the buyers who are, getting your power connected. Correct?
Absolutely. In fact, even after we do the expansion, which is answer to the first question, our power consumption per unit will go down, which will what happen is, even though our capacity will increase by nearly 3 times, our power requirement will be a little less than 2 times only. That is because the equipment what will be adding will be the latest, least power consuming equipments.
Oh, that's it. Thank you, sir. Thank you so much.
Thank you, Naresh.
Thank you. The next question is from the line of Apurva Mehta, an individual investor. Please go ahead.
Yeah, hello. Good noon. My question is, what is your current capacity utilization for Q1?
The Q1 capacity utilization is about 68% for cement.
Okay, and what was the total sale in terms of volumes?
I couldn't get that question. What is that?
What was the total sales in terms of volumes?
In volumes, the Q1 was about 61,000 tons for Q1 cement sales. 61,000 metric tons.
Okay, and what is the average cost per kg?
Our net average realized price is 4,100 rupees for Q1 compared to previous quarter of 4,014 rupees. So there is only about 2% jump in the price variation we have got. But in quantity wise, we have increased by 7%.
Okay, yeah. Thank you.
Sure.
Thank you. The next question is on the line of Vaibhav Sharma from Cogent Research. Please go ahead.
Thank you. First of all, congratulations, sir, for a good set of numbers. And I wanted to ask 2 questions regarding CAPEX. So, what if we do the CAPEX? What will be the lead time to complete the whole process from point we decide? Second question is, what will be the incremental revenue that we will generate from this CAPEX?
Okay. So the first question, did you ask me the cost of the CAPEX and the time it will take to complete the project, is it?
Correct.
Yeah. So Vaibhav, thanks a lot for your comments. But for CAPEX, like you said, the technical feasibility study is almost complete. So indicative figures about 120 crores investment is what we are seeing. With this 120 crores, our capacity will increase by almost 3 times. Whereas the CAPEX cost of the industry is around 8,000 to 9,000 rupees per metric ton, we are completing it in less than, 2,000 or 3,000 rupees per metric ton. That is mainly because we are not adding most of the we are only optimizing the plant. So CAPEX, the typical timeline from the day we dig the first dig to the first bag will come out, we expect about 3 quarters. Within 3 quarters from is what we reasonably expect. And then we say incremental benefits are going to be like this. Since this project is done to reduce the usage of fuel and the consumption of electricity per unit of cement, EBITDA margin will drastically increase compared to currently. We will be expecting about 30 to 40% increase in EBITDA per metric ton compared to right now. And of course, with that contribution, since the capital cost is lesser, we are hoping to contribute around 50 to 60 crore worth of EBITDA only on the incremental capacity running at about 80% capacity. So this project is something which you should have done long time back, but I guess it is never too late, and now we will be implementing it, once the technical feasibility studies are complete.
Okay, that's great answer, sir. So another thing I just wanted to understand, have you started using petcoke in, I think, last quarter from Q4 FY22? and this quarter you have used. So we are fully shifted to pet coke, or still we are using traditional coal also?
No, we have completely shifted to pet coke, but right now what is happening is only to fire the kiln to begin with. We still are working utilizing coal, but that is less than 5%. So overall, they are already shifted to pet coke. The reason, in spite of that, the fuel cost, the raw material cost, everything is increased is because the cost of fuel itself has increased on absolute levels on the both the sides, be it coal or pet coke. So let's say, for example, the cost of per kilocalorie of pet coke was about 1 rupee 10 paisa in the quarter one of FY22, and coal was around 1 rupee 70 paisa in quarter one FY22. So this has increased to, from 1 rupee 10 paisa, it has increased to 2 rupee 35 paisa for pet coke, and almost 4 rupees for coal. So if you look at it, even to pet coke, we could not get the benefits because there is a general increase in the fuel cost due to ongoing geopolitical situation like Ukraine war.
Yeah. So that's why I asked the question, because I'm seeing the numbers from last quarter and this. So I doesn't see the number much difference in the raw material prices. Yeah, so that is that. And what will be the average selling price for per metric ton? I think if you have answered, but I missed out on that.
Sure, sir. My first quarter was about 4,115.
4,115. And so what was for the full year of FY22?
FY22 around 4,073.
Okay. So is there any scope of more improvement in the prices for this year?
Yes. Now that the coal prices have increased, most of the cement plants have not responded to the increase as of now because of the subdued market. So typically, price rise do happen in Q3 and Q4 particularly. So once Q4 it will continue to remain at that level eventually. So yes, there will be a price increase, but of course not immediately. We are expecting a significant price increase from Q3 onwards.
Okay. And sir, one last question on the distribution front. I think you, for answering to some earlier participant, you told, so you are increasing your presence in more and more villages. So can you just give a ballpark number in currently in how many villages you are currently supplying, and what is our basically what is our reach in terms of area in which we I think we are majorly into coastal Karnataka and some part of Maharashtra and Kerala. So how we are seeing this shaping up if we are increasing our reach? So will we be increasing in the same region or any other region?
Sure. The cement, of course, is characterized with a very high logistic cost. So what we manage focusing on to keep the market within 200 kilometers. The more nearer you sell, the better realization you can expect. So what we are trying to do right is Kerala market, this quarter we haven't sold anything. So we left out the Kerala market because of the high logistic cost. We are reduced to coastal also. Most of the sales what we see right now is coming from the nearer regions. But we are already continuing, and we are continuing working on to reach through the villages. Number of villages, I may not have the exact count, but pretty much the reason we are going into rural is because tendency is rural ka ek advantage is we get a better price relation. The disadvantage is the quantity, the amount of service, and of course the lesser quantity and better pricing is what is going to happen. And for our cement, where variable cost is very high, margins do play an important role. So we will be focusing on the village, by which we'll be lessening the dependent on the top 5 customers.
Okay. So it will be mostly through your existing dealer distributor network, or any new dealer distributor you will be adding, or directly approaching the retailer. So how it will?
What we will do is we will establish new dealerships also. Plus, if there is an existing dealer who is supplying to the rural market, we help him to sell it more over there. So there is going to be a mix of both.
Okay, sir. Thank you. That's it from my side.
Thank you, sir.
Thank you. A reminder to the participants, anyone wishing to ask a question, may please press star and 1. The next question is from the line of Sachin from Sagar Power and Automation Private Limited. Please go ahead.
Yeah, thanks for the opportunity. Sir, my question is for the solar revenue.
Sure.
So last quarter, it was 7.15 CR, and this quarter something 5.67 CR. It reduced drastically. As far as segment results, profitability also it is reduced. Last quarter 5.80 CR, and this quarter 1.15 CR. So what is the reason for this?
Okay. No, you're talking about power, right? Segment results power-wise?
Yeah, solar power generation supply. So segment-wise, revenue-wise, last quarter it was 7.15 CR, and this quarter 5.60.
Chalo.
I got it. So, okay, now typically first comparing with the previous preceding quarter like 30th June, there is a significant increase of 250%. In June 30th June 2021, it was 1.61, and now it is higher. But if you compare with the previous quarter, it is mainly because last quarter, typically what happens in last quarter of every year, all the entities have to meet up their renewable power obligations, which is when we tend to get a better pricing also. So what we do is right now we keep whatever excess power, only if we get certain price we sell it, otherwise we just keep it in the closing stock. At that time, typically we tend to sell at the higher level. So that probably impact would have this year too. That cyclical impact. So this fourth quarter also should be a similar jump like how we see in the previous quarters or previous year quarters.
Okay. And the second question, how much is our long-term debts and short-term debts?
The total outside liabilities is around 165 crore, approximation 165 crores. And our short-term debt, which is, I call it outside liabilities, as of now is on the balance sheet is about 24 crores. But if you negate the cash balances in the bank itself, it is about 18 to 19 crores is what current liabilities will be. This is outside liabilities, what we call as the overdraft limits. Apart from that, the term loan maturities is what is showing up on the balance sheet, which is around 14 crores. Long-term debt, we are continually repaying on time every time. So this time the long-term debt increased solely for the new solar project which we commissioned last year. So this will continue to keep going down quarter on quarter and year on year. Till date, we have been repaying every time correctly, and that trend will obviously continue.
So having made any repayment for this long-term debts, so before, I think within 6 months, last year actually we have done something 18 CR. So before start the capex, before kick off the capex plans, has there any plan to repayment of any loan or long-term debt?
No, not apart from internal generation of the funds. There is no direct plan to secure funds from somewhere else and replace it as of now. Our management thinks that whatever loan what we have secured from the bank will be repaid out of the profits only. And did you mention about the financial cost for last year and this quarter?
Financial cost?
So I thought you asked me a question regarding, you also added a question regarding the financial cost, right?
No, sir, not financial cost.
Sorry, yeah,
repayment, regarding repayment, has there any plan to do any repayment for this coming within 6 months, like half yearly? This quarter?
Nothing more than what we have a yearly obligation to repay to the banks.
Okay. Now for the capex, we have now 100 CRs we are utilizing for the capex, and that 100 CRs, you told us that that will be from unsecured loans from the promoter.
Yes, we haven't finalized that, so there are two options what we have. Either we go for a private placement and then the debt or completely through private placement or through the unsecured debt what the promoters can bring in. So it is going to be a mix of all these things depending on how the management takes a decision on. Since we don't have the feasibility report and the project cost entirely at hand, it will be too premature to decide what would be our means of finance.
Okay, sir. Okay, that's all much, sir. Thank you.
Thank you.
Thank you. Ladies and gentlemen, that was the last question. I now hand the conference over to Ms. Supriya Madhye for her closing comments.
Hello. I thank you, Mr. Venkatesh Katwa, for his remarks and sharing his insight on the company, and everyone for joining the conference call. If you have any queries, you can write to us at info@kirinadvisors.com. Thank you.
Thank you, everyone.
Thank you. Ladies and gentlemen, on behalf of Kirin Advisors Private Limited, that concludes this conference call. We thank you for joining us, and you may now disconnect your lines. Thank you.